called Inflation and Famine. This is the Equity Management Academy weekly podcast for April 18th, 2022. Summary. The war in Ukraine continues to put stress on global food and commodity supply chains. The mainstream media does not appear to be giving this issue enough attention. Just as supply chain issues caused by the pandemic were beginning to ease, now the war in Ukraine is causing more supply chain issues. Fundamentals. The war in Ukraine continues to put stress on global food and commodity supply chains. The mainstream media does not appear to be giving this enough attention. Zero Hedge published a report highlighted that Europe depends on Russia, Belarus, and Ukraine for energy, palladium, nickel grains, pig iron, certain types of steel, and many other commodities. Energy especially is a vulnerability as Russia now is demanding payment in rubles. Europe cannot shift to other suppliers or energy in the short term. Pig iron and other iron and steel products are also being impacted heavily. The EU also facing import issues with goods from third countries that rely on imports of raw materials from the war zone. Just as supply chain issues caused by the pandemic were beginning to ease, now the war in Ukraine is causing more supply chain issues. Trade with Russia, Ukraine, and Belarus has come to almost a complete halt with the West. Although they are not a major percentage of world trade, they are critical in certain sectors. The EU is losing exports to the war zone as well as facing import shortages. The war in Ukraine shows no end in sight, so these shortages are not going to be short-term. If Russia blockades Ukraine's access to the Black Sea, it would further impact any Ukrainian exports of grains, metals, and other commodities. China's COVID policy of locking down Shanghai is further impacting the global economy. Shanghai has a population that ranks in between Florida and Texas. It is the world's busiest port. Locking down means a small but significant chunk of the global economy is locked down. The lockdown may make the logistics issue of 2020 and 2021 look small in comparison. China's lockdown also does not appear to be shrinking. If anything, the lockdowns appear to be spreading. Recession on the horizon. In a talk recently, investment advisor Stephen Van Metre warned of a coming recession. With inflation running higher and interest rates rising, consumers are starting to pull money from banks. The Wall Street Journal warned that for the first time since World War II, bank deposits could decline. Raising interest rates could ripple through the economy in unexpected ways, such as bank deposits declining. With rising interest rates, consumers search for a better return on their savings. When banks keep savings return rates low, money moves out of banks. Some banks had been reaching regulatory limits on their capital, so the withdrawals should not hurt the banks. Banks had deposits on hand which they could not loan out. Profit margins for banks should increase as deposits decrease. One place the savings may go are money market funds, but we already have $1.7 trillion in money market funds. Money market funds may raise their rates to make them even more attractive than bank savings rates. Usually, consumers are slow to move money out of savings accounts at banks, but that could occur much faster with inflation and the Fed raising rates more rapidly. This summer, the Fed is supposed to start unwinding its balance sheets. Banks will be happy since it will release some of their capital and allow banks to persuade consumers to shift funds from saving accounts into money market accounts. Many of the money market accounts are backed by short-term treasury bills. If a flood of money enters the short-term part of the bond bill market, then short-term rates should fall, which will then drag down long-term rates. The opposite of what many believe will happen. Many markets have to invest in T-bills of less than a year, since they have to stay liquid because no one knows when the holder of the money market funds will want their money. Inflation for the nation? Question mark. The Consumer Price Index hit 8.5%, the highest since 1970s and 1980s. Higher prices and high inflation usually leads to consumer spending less, which brings both rates down. We expect the CPI to cool off. Food and energy prices are driving the CPI, with energy up 11% over the prior month, but crude oil is already coming down. Wages are not keeping up with inflation. Average hourly earnings adjusted for inflation are down minus 2.7% year over year. Consumers are not keeping up with inflation, which means less spending, which means less inflation. If banks are going to flood money market funds with money from savings accounts as investors seek higher returns, then money market funds have to buy more T-bills, which will drive short-term rates down, in turn driving inflation down and setting the stage of a recession. The markets. The key is to understand how to trade this fundamental situation. We have a lot of volatility this morning, Monday, April 18, 2022. Silver made a high of 26.49. It has then come down to 26.16 and then back up to 26.30. So we have a great deal of volatility in metals. Gold is at $18.96, but we crossed the $2,000 range. For silver, we are below the weekly variable changing price momentum indicator and standard deviation of sell 1 level of 26.28. The variable changing price momentum, or the mean, at 26.28. The signal is short unless there is a close about 26.28. The target for the weekly is 25.59. Silver is warning you to be careful up here. It is a place where the market is likely to move down in the short term. For gold, we made a high of 2003 early this morning, April 18, 2022. We are above the daily resistance level of 1896. We are also above the weekly sell 1 level of 1894. The next target is 2012. The price is entering an area of distribution of supply and support levels. When resistance is broken, it becomes support with a target of 2012. If we close below 1994, we will activate weekly and daily short triggers, a strong short signal. Bitcoin made a low of 38,535. It did not quite reach the weekly buy one level of 38,468, but found buyers at a higher level. Now we are in a bullish signal with targets of 40,330 and 40,637. Option. Opinion and strategy. The 10-year Treasury is at 283, which is a significant increase over the past couple of years. The 3% yield is in the cards, Equity Management Academy CEO Patrick MontesDeOca said. The inflation rate in the U.S. is about 8.5%, and the 10-year note, even at 3%, leaves at least 5%, 5.5% negative yield. That cannot continue. At the same time, we have a $30 trillion debt. Interest rates, according to the IMF, should be about a percentage point above the inflation rate. So interest rates should be about 9 or 10%. If that happened, MontesDeOca said, the global economy would collapse. There is no doubt in my mind. End of quote. If the Fed raises rates too fast or too aggressively, they will kill the equity markets by printing money. The Fed has been protecting the equity markets. At the same time, the US dollar has significantly declined. Even though assets such as real estate have increased in price, the dollar is down about 30% in value. The increase in asset price is just reflecting the devaluation of the dollar. Gold and silver will be looked at as a safe haven asset in times like this. Continue to accumulate long-term positions.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, ema2trade.com, or listen to any of our previous episodes.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our Variable Changing Price Momentum Indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit ema2trade.com for more details.